G'day everyone and welcome back to another episode of the Aussie Dividend Machine. Thanks for joining me. In this episode we'll be going over another portfolio update. I wanted to cover the breaking news on three interesting shares on the ASX at the moment, that being Afterpay, A2M and Pointsbet Holdings. They've all had some pretty big announcements in the last few weeks, so I wanted to summarise those and go over my positions on those companies. I also wanted to take a look at ethical investing and the impact it's having on the coal industry and that sector of the market, as well as the ETF opportunity that exists to get into the ethical investing movement. And then finally, at the end of the video, we'll have a look at my portfolio and the latest moves I've been making, in particular, the two shares that I've decided to sell. We'll get to that sell-off later in the video, so stick around for that. Don't forget to give the video a like if you enjoy it, and please subscribe to the channel if you're enjoying the content. As always guys, this video is for entertainment purposes only. It's not to be considered any form of financial advice. Before making any investment decisions, please go and see a licensed financial advisor. Now, over the last 12 months, Afterpay has had an absolutely stellar run. They're up something like 900%. It seems like there's just nothing that can stop this company from growing. However, in the last couple of days, we've had PayPal come out and tell the market that they will also be releasing a pay-as-you-go style payment service. They're calling it Pay in 4, and it's pretty much identical to the service that Afterpay provides. Now, this is really problematic for Afterpay because, as you know, you're probably familiar with PayPal and know just how many merchants have PayPal as a payment option. PayPal's making this service a super easy one for merchants to adopt. They don't need to make any changes to their current PayPal integration. This is certainly trouble for Afterpay. PayPal's influence on the market is much larger than Afterpay's, and they definitely have more exposure globally. I feel like this was always a concern for Afterpay, and it really is exposing their quite narrow moat that they've got. The service Afterpay provides can obviously be quite easily replicated by other providers, as we're seeing now with PayPal launching this product. As a result, we've seen a sell-off of Afterpay, Zip, Splitit, and other companies that are in this space, and it's really impacting the share price at the moment. Now, Afterpay is not a company that I'm invested in, but I would err on the side of caution if it was on my watch list. I think this sector of the market has some really fierce competition. And with the likes of companies like PayPal now throwing their hat in the ring, I can see it really hard for Afterpay going forward, especially considering they're not even turning a profit just yet. On to the next topic, I wanted to speak a little bit about Pointsbet Holdings. Pointsbet, similar to Afterpay, have had a really good previous 12 months. Now, Pointsbet has just gone on to a trading halt because they're doing a capital raising exercise. Normally, when a company raises capital, they issue shares to existing shareholders at a discount to what they're currently trading. However, Pointsbet has issued a capital raising exercise, and the price of the shares that they're issuing, these are the new shares that they're issuing to existing shareholders, are actually double the price of their current stock market share price. This means if you were holding Pointsbet prior to the capital raising, your shares were worth approximately $7. Even if you didn't participate in the capital raising, the share price for Pointsbet is now $14. That's a 100% increase in a week. Now, compounding this good news for Pointsbet shareholders, NBC has also announced that they'll be partnering with Pointsbet in the US market. NBC is obviously a huge broadcaster in the States, and having this partnership with Pointsbet is only good news for Pointsbet shareholders. Now, if you'd like me to have a look at Pointsbet's fundamentals in a future video, let me know in the comments down below. There's potential that they could have some massive growth going forward. Now, the last big news I wanted to talk about on the ASX is A2M. A2M is currently on my watch list, and that's because of their incredible growth over the last 5 years. A2M's latest results are no different to those they've presented in the past 5 years. They're still showing tremendous growth. In addition to this, they've got a low level of debt, and they're building shareholders' equity at a rapid rate. It seems like nothing can stop A2M. In a previous video, I highlighted the concerns I had about the relationship between Australia and China. This relationship at the moment is under stress, and as a result, China has placed some trading restrictions on Australian produce. This started with meat and barley, and now has recently moved to Australian wine, and as a result, Treasury wine, which used to be quite a good performing share, has taken an absolute massive hit to its share price. This is based on fears that they won't be able to sell their product in the Chinese market anymore. China has accused Australia of providing its best winemakers with tax concessions, making it easier for Australian winemakers to push their product into China. This is currently disputed by the Australian government, but it remains an unresolved issue. It's Treasury Wine shareholders at the moment who are paying the ultimate price. Now, in that video I made looking at the relationship between Australia and China, I flagged A2 Milk as a potential at-risk stock. In my opinion, the next logical step for China, if they continue to impose restrictions and tariffs like they have been, would be to target the Australian dairy market. And of course, this is exactly where A2 Milk operates. When you look at their segmented report, you'll find that A2 Milk's revenue comes approximately 50% from Chinese sales. Therefore, if China imposes restrictions, A2 Milk is going to feel a massive impact. So you might be asking, well, why are you raising this again now? In the last few weeks, we've seen some massive insider trading within A2 Milk. There's been a huge sell-off of shares by top executives. Now, this isn't all that unusual. Insiders do sell shares from time to time, but they normally provide an explanation of exactly why they're doing that. In this case, A2 Milk has provided no reasoning. And on top of this, the quantum of shares that have been sold are not minor. There's been some huge sell-offs by some of their top executives in the order of more than 80% of their shares. This rings alarm bells for me, and it makes me wonder, what do they know that the general public doesn't? Looking at the political landscape at the moment, this is the only thing I can think of that might trigger such a massive sell-off. Now, I understand this is politically sensitive information, and it would provide a pretty good reason why the A2 Milk executives are not providing a reason for their share sell-offs. Now, I just want to make this clear, this is just speculation on my behalf, but because they haven't provided any real reasons, it leads me to think this might be the case. Hopefully within the next few weeks or months, we do get a bit more clarity from A2 and their executives about why they've made these moves. This should clear things up, but until then, I definitely won't be making any purchases of A2 Milk shares. So the next topic I wanted to touch on was the idea of ethical investing. Ethical investing is the idea of only investing in companies which are ethical in their practices. Now, this might be in line with things like climate change targets or human rights movements. Recently, we've seen a huge push against coal miners, and as a result, some of the big coal miners in Australia have seen their share prices get absolutely smashed. On the other hand, there's some ethical investment ETF funds which have seen opposite results. Their share price has absolutely exploded into positive territory. The question remains, is an industry like coal still profitable? It seems like coal miners, similar to a lot of other stocks on the Australian stock market, have had a pretty tough year, but historically their margins have been good and they've been able to increase revenue year on year. Now, what sparked my interest on this topic was a video I saw at Washington Soul Patts annual general meeting. Now, Soul Patts is a managed investment fund which is listed on the ASX. Their fund performance over the past 20 years has been incredible. And if you had your money in Washington Soul Patts at the beginning of the year 2000, you would have outperformed the market by a significant margin. This demonstrates to me that the guys at the head of this company really know what they're doing when it comes to investing. One of Soul Patts' biggest investments is in New Hope Coal, which is an Australian ASX listed coal miner. New Hope pride themselves on providing very high quality coal, which is less frowned upon than other dirty coal types that are produced around the world and also in Australia. Their high quality coking coal can be used for smeltering steel, which a lot of other grades of coal just can't be used for because they don't generate the right amount of heat. Now, Soul Patts own something like 49% of New Hope. They're a major shareholder in the company. They have reduced their position in New Hope slightly, but they still remain a major shareholder and it forms a large part of their portfolio. So with this ethical investing movement, it's no surprise that a few tricky questions came up at Soul Patts AGM. I'll play the video now so you can see for yourself just how their executives handled the questions.
Countries are expected to increase their targets in November next year. And the expectation, given the report from the UN last year, is that coal will be phased out in OECD countries by 2030.
Well, and that, we're not saying that that's a risk that might not occur, but what we are saying to that is the OECD countries are reducing their coal consumption, but that coal consumption is being taken up by Southeast Asian and India nations. So, we think that, and then overlaying that is the reduction in available supply. So even under any of the scenarios that you or the IEA describe, we think that people who have good quality, low-cost coal and a permitted mine for the next couple of decades will be in a good place.
So as you can see, some pretty high tensions at that meeting. There were some questions around the Paris Agreement. The Paris Agreement is between a number of nations, and they're trying to establish an end date for coal. This is obviously to achieve climate targets and help reduce the pollution across the world. Now, famously, Donald Trump actually pulled out of this Paris Agreement, so America's not involved any longer. It's also worth noting that a lot of developing countries rely pretty heavily on coal because it's quite a cheap energy resource and they don't have the money to invest in renewables. However, the landscape of this may be changing as the price of renewables continues to drop. At the moment though, New Hope Coal, for example, forecasts that developing economies still have an increasing demand for coal, especially the high quality coal that they produce. It's understandable to see why Soul Patts owns New Hope Coal and such a large portion of the company like they do. The demand is still there from developing economies, but ethical investors are putting a lot of pressure on all kinds of managed funds, superannuation funds around the world to start dropping these companies from their portfolios. The question remains, for the individual investor, is there any value left in companies like New Hope? Their share price is at an all-time low and their PE ratio is very small compared to the rest of the market. We've also identified that there are international opportunities for selling this coal and the demand is still increasing despite the global trend away from coal. So the coal market is something we'd call a negative growth market. Now, Peter Lynch in his book One Up on Wall Street famously identifies negative growth markets as an opportunity for investors. When the majority of investors are staying away from such markets because of their negative growth perceptions, there are still companies that can outperform in negative growth markets. A great example of this is Philip Morris. Philip Morris is a manufacturer of cigarettes. Up until recently, Philip Morris shares were doing very, very well despite being in a negative growth market. It helps that the product they're selling is an addictive product, but they were able to identify opportunities in emerging markets, similar to what New Hope may be doing with coal. Now, you must consider your own ethical position before deciding to invest in a company like Philip Morris or in coal. However, I believe there may be opportunity coming up in the near future. Before making any investment decisions on coal companies like Whitehaven Coal or New Hope, there are others that operate in Australia. I'd first like to see some improving results coming out of this coronavirus pandemic. For the purpose of this episode, I just wanted to demonstrate what a negative growth market is, a modern day example such as coal, and reiterate Peter Lynch's point that there are some great opportunities that can still be found in what seem to be quite unattractive markets. One to consider: do your own research and have a look at these companies. Okay, now, so onto my own personal portfolio. Let's have a look at what I've been doing this week. So this week, instead of making a purchase, I've actually sold off 2 of the shares in my portfolio. These were 2 purchases I made just before starting the YouTube channel. So you guys didn't get to see the analysis and reasoning why I bought these companies. The first company I'll talk about is NIB. Up until recently, NIB's fundamentals were looking pretty good. They were increasing shareholders' equity at a rate of around 15% year on year. They were doing similar numbers with their revenue increase as well. Their earnings per share were also impressive, hovering around the 17 to 13% mark. And on top of this, they were keeping debt levels at a manageable rate, about 40% of their equity. So what changed for NIB? Well, 2020 results were released and we saw a lot of these metrics actually turn negative. They hadn't achieved any growth at all and we weren't seeing any improvement in a number of the key fundamentals that I like to look at when deciding on purchasing or selling a share. Now, don't get me wrong, I like the story behind NIB and I actually use them myself. They're my private health insurer. However, I want this portfolio to do really well. So I've got to be quite brutal in the way that I manage the companies and their performance. Unfortunately, negative growth for me is just not good enough, so NIB has got to go. Sorry NIB, but that's just the way of the game. Now the other investment in my portfolio is a company called Shopping Centres Australia. Now I actually found out about this company through a super fund manager. He said that their fund has quite a lot of money in SCP because of its very stable performance over the long term. SCP owns small shopping centres. Their major tenants are massive supermarkets such as Woolworths and Coles. They have these companies on very long leases, 10 years plus usually. As you would expect, these supermarkets don't miss rental payments. They hit them every time, and this means there's a stable income coming into Shopping Centres Australia. This is what attracted me to the company, and they pay a very consistent dividend. I'll put up a graph of their dividend payments. They haven't missed a beat. It's consistently increasing. It's a great stock if you're looking for a very defensive asset. However, when you look at their growth, the numbers are poor. They've missed earnings per share growth over the last 2 years. They've missed income growth over the past 5 years. However, their equity growth is acceptable. They also operate with a pretty low level of debt, which is quite a good thing to see. However, it doesn't make up for their poor growth performance. If I was a self-funded retiree, I might consider holding on to Shopping Centres Australia, especially in the uncertain times we have at the moment. However, being younger, I'm looking at taking a bit more of a risk in this approach and going for a company with a much higher growth rate. So this is the start of a bit of a restructuring of my portfolio. In a future video, I'll lay out exactly how I'll be dividing up the shares that I'm looking to purchase and placing them in different categories. These categories will allow me some flexibility in choosing different shares on the market. I also want to clearly present this investing strategy to you, the viewers, so you can track how I'm doing and see how it compares to your own portfolio. So watch out for that in an upcoming video. Well, as always guys, thank you very much for watching the video. If you like the video, make sure to give it a big thumbs up. And if you're enjoying the content, please subscribe to the channel. That's all from me for now. Make sure you stay safe out there, and I'll see you in the next video. Cheers.